Hey everyone, welcome to another exciting dividend stock investing video. I want to cover in the video today the topic of ETFs, or exchange traded funds. A lot of dividend stock investors in our community use ETFs as their entire strategy or as part of their strategy. And ETFs come in a lot of different flavors. There are exchange traded funds that are focused just on dividends, and there are exchange traded funds that track the overall S&P 500. So I'm going to cover some of those ETFs in the video today, what I think about them, what the pros and cons are. I also want to get into an exciting interview, a guest interview in the video today. I'm proud to announce that Georgiy, my friend over from Funancialism, another YouTuber, a really cool Instagrammer as well, he's on the channel today with me for a really exciting interview because he tends to specialize in ETFs. So he brings a world of knowledge about ETFs over to the channel here. So thank you so much, Georgiy. And by the way, if you want to check out his channel, which is called Funancialism, check out in the pinned comment below. I've got a link to his channel and also his Instagram, which is really amazing as well. And before we get started today, I also want to welcome all of the new members of the community. My homie, Brandon Beavis Investing. He is the best Canadian investor in the world, in my humble opinion. Also, one of the best overall investors in the world. He has one of my favorite YouTube channels. He just sent all kinds of people over to my channel here on PPC Ian. So thank you, Brandon. I will link in the pinned comment below to Brandon's channel. If you have not been there, check it out. It is one of my favorites. And I'm so grateful to have all of the new subscribers that have come over here from Brandon's channel. So I have a really exciting video today, everyone. Get ready for a dividend stock investing video about ETFs. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So before we get started, please go ahead and smash that like button. If you love ETFs, dividend stocks, passive income as much as I do, and please remember to subscribe as well. I have so much more content on the way. Don't forget that notification bell. You will be alerted as soon as my new videos are live. And so what I'm going to do in the video right now is I want to share some ETFs. Then I want to get into the video interview with Georgiy over from Funancialism. So check it out on the screen right now. These are some ETFs that I researched. These are some of the popular ones in our dividend stock investing community. I don't own any of these ETFs, but I could see possibly at some point in the future I would consider adding some ETFs to my portfolio. So the first one is the Vanguard S&P 500 ETF. The ticker for that one is VOO or VOO. And this one is a mammoth ETF. This one tracks the S&P 500, and the net assets under management are $753 billion. So this is a massive, massive ETF. The price per share is $399.70, and it has a starting dividend yield, which is a really low at 1.32%. Now, obviously, the reason the starting dividend yield is so low is because this particular ETF tracks the overall S&P 500. And there are many companies in the S&P 500 that do not offer dividends, at least yet, although they may in the future. One such company, for example, that's really heavily weighted in the S&P 500 that I love is Alphabet, or the parent company behind Google and YouTube. And obviously, we wouldn't all be here today enjoying each other's company in the community here about dividends if it were not for YouTube. And so that's an example of a stock that an investor can get exposure to through the S&P 500 ETF while still getting that dividend income. So check it out on the screen right now. You can see on the chart next to the VOO ETF, up and to the right, this is one that's done really well over the long term, and it seems like the pace of returns has been accelerating in the short run. And that tells me, honestly, we're probably going to revert to the mean sooner or later. The market overall has been very, very hot. And so one of the things that's important to realize with this ETF is the expense ratio is super low. It's only 0.03%. And so the overhead management fees of buying a passive instrument like this are, it's low. And so not too much goes to the middleman. Now, I did a dividend analysis to understand, the starting yield is low, but how quick is it growing? And so the thing about an ETF is it doesn't represent just one stock. It represents a lot of different stocks. And so one thing I did when I compared dividends and dividend yields over time is I actually had to summarize an entire year, because this ETF pays dividends quarterly, but they fluctuate by quarter because different companies in the index pay their dividends on different schedules. And so basically, that's why this is a little bit different, the analysis, than when I analyze a dividend stock. When I'm analyzing a dividend stock, I can just look at the last dividend generally and extrapolate that into an annual yield and use that for sakes of comparison. But for this particular ETF, or really any ETF, because it comprises multiple stocks, I'm looking at 4 quarters of data, and that's why I get the current dividends per year are 5.288. Based on the last 4 quarters at least. And in the 5-year ago period, that was 4.004. And so if I do the compound annual growth rate formula on those annualized dividends, I'm seeing that on average, the S&P 500 increases the dividends by 5.7% per year on average. And so this is why a lot of members of our community use this ETF. Even though it's a broad market ETF, it still gives dividend income. And yeah, the starting yield is small. No one's going to retire overnight on cash flow at a 1% level or just over 1%. But because it's growing there at a pretty nice clip over very long periods of time, the cash flow can become meaningful for someone who is disciplined and diligent and sticks to an ETF S&P 500 focused plan. And so as you can see on the screen right now, one of the things I don't have on here is the PE ratio. I wasn't really finding good information online, good sources of information online for forward PEs. I'd love to know from members of the community, do you guys have any tools or resources that you use at home to look at EPS and PE forecasts for ETFs or for entire indices? I know one member at our recent PPC Ian meetup was mentioning that he likes to use Barron's. And so I'd love to know if there are other sources of information, or if others can confirm that Barron's is a good source of information there. But when I last checked the S&P 500 index, at least on a trailing 12-month basis, that PE was up there. It was up there kind of like low 40s, at least based on the data source that I could find. But that was just one website's information. Now, if you don't want to go with the Vanguard S&P 500 ETF, there are certainly other alternatives such as SPY and IVV. These are both other alternatives from other fund companies that offer S&P 500 ETF. Now, one of the things I would say about an ETF that is so valuable is it gives instant diversification, and it gives someone, even with an income focused, like most of the members of this community, gives them exposure to companies in the ETF like Alphabet, which are just rock solid companies in my humble opinion. One of the companies I'll probably buy one of these days, even though it doesn't pay a dividend at this time. And so I want to go on to the next ETF. Check it out on the screen right now. The next one is probably my favorite ETF that I've analyzed so far, and this is the ProShares S&P 500 Dividend Aristocrats, or NOBL. This particular ETF is very popular in the dividend community, and the reason for that is it focuses on the dividend aristocrats. Dividend aristocrats are those members of the S&P 500 index that have happened to pay and increase their dividend every year consistently over the last 25 years or more. So literally, these are companies throughout the great financial crisis, throughout horrible times, throughout good times, have consistently increased their dividend each year for the last 25 years or more. These are rock solid companies, and many of the companies I own in my personal dividend stock portfolio fall into this Dividend Aristocrats list. And so, as you can see on the screen right now, this one is trading right now at $91.12. The net assets under management is a lot lower than VOO, but it's still huge. It's 8.58 billion, so that's a pretty good sized fund. And the dividends, I look at them very similarly to VOO. You can see a dividend analysis there, and I look at the last 4 quarters. It pays quarterly. And again, you can see they're lumpy by quarter because different components of the ETF pay out their dividends on different schedules. What is so interesting when I ran these numbers, and I don't know if I'm making some kind of mistake or not, it almost seems too good to be true, but what I'm seeing at this point, and point out in the comments below if I'm wrong. This is a community, and the benefit of this community is for all of us, myself included, and I'm always learning from all of you out at home. So thank you for all of those valuable comments. And what it shows, though, is a compound annual growth rate of 12.2%. So on average, the NOBL ETF has increased the distribution, the dividends, by 12% per year on average for the last 5 years at least. And so what's amazing is even though the starting yield is just below 2%, 1.93%, it's surprisingly low, honestly, the starting yield. What I have proven so many times is for longer term investors with a really long time horizon that have a lot of years ahead until they want to tap into their stocks for dividend income, for cash flow, starting yield honestly isn't as important. I mean, it is important as long as it's kind of above 1 or 2%, but it's that growth rate that is so important. And the fact of the matter is this particular ETF has a massive growth rate around the dividends. And so that is so exciting to see. Check it out on the screen right now. You can also see in the chart, the stock chart for the ProShares NOBL up and to the right. And so it's a strong performer. And it just goes to show companies that pay dividends tend to have competitive moats. Companies that pay dividends tend to be solid companies. These are great companies. These are some of the best companies in the world. And so if I had to pick a particular ETF, and I was just starting out perhaps, and just speaking hypothetically to my own personal situation, and I didn't already own all the stocks I own because I probably own a lot of the components of this ETF individually already. This is an ETF that I think is really well geared and interesting for a dividend stock investor. And so I really like that about this ETF. And so after that, I went into one last ETF that I want to analyze for all of you today. So check it out on the screen right now. This one is from iShares. It's a smaller ETF, only 1.34 billion in net assets. This is the MSCI World Index. And so this one is kind of like the S&P ETF, but even broader. It takes worldwide markets from developed countries, from established countries, established stock markets, and it's kind of looking at the basket of worldwide companies. And so you get a lot of global diversification here, although I would say you get that even with the other two ETFs, because most of these companies in any of these indices are globally oriented companies. Nonetheless, this one gives true global diversification. And worth noting, the expense ratio is 0.24%, still low, honestly, even though the expense ratio was 0.35% for NOBL. These are higher, obviously, than VOO. These are still really low expense ratios. And so that's the beauty of an ETF. These are more passive investments. These aren't actively managed mutual funds. These are mutual funds of sorts that are traded on stock exchanges that you can buy in a regular broker account that tracks certain indices or certain baskets of stocks. And so that's why the expense ratios are so low. But anyway, this one pays a starting yield of 1.4%. But what's interesting is the dividend is paid semi-annually, so they don't pay quarterly. They pay twice per year, semi-annually. And when I calculate the compound annual growth rate on dividends for this one, I'm only getting a 2.6% growth per year on average for the last 5 years. And as you can see on the stock chart, though, this one is up and to the right quite a bit. So you got a good amount of capital appreciation there. I would say this worldwide index is probably not as well geared for a income-oriented investor unless it were a smaller part of the portfolio just for the sake of diversification. But certainly for an income-oriented investor, I would say the Aristocrats is really awesome. VOO is obviously a good one as well. And I'll include a link in the pinned comment and in the description below. I did a few videos a while back on high yielding covered call ETFs. Those are really good for dividend investors as well who need a ton of cash flow right away to pay bills. The ETFs I just covered today, These are more looking longer term. These are for investors who want to commit to a regular investing schedule and let the money compound and build both capital appreciation and wealth, but also dividend income over long periods of time. So with that, I want to give some pros and cons of ETFs, and I want to get into the interview with Georgiy from Funancialism, because that is really the most exciting part of the video today. But I do want to set the scene here. So check it out on the screen right now. And so what you see now is just a few pros and cons that I personally see with ETFs as part of a dividend-oriented strategy. The pros are this is a really easy approach, and after all, aren't we investing in dividends for passive income so we can live the good life? I just went on a really long run. I just got back from it, about 7 miles, and that's what I like doing, so I'd rather be doing that than analyzing stocks, and so ETFs make that really easy for investors that want an easy approach. ETFs have a great overall performance. Active management rarely beats the market over the long run. So what I'm doing, actively managing my stocks, most likely over the long run, hey, will I lose out to the S&P 500? Possibly. That's what happens with most investors over the long period, so we shall see. I would say pros with ETFs is a sleep well at night. It's a sleep well at night strategy because it's so broadly diversified. And I would say less analysis is needed because with an ETF, the investor is not picking individual stocks. With an ETF, the investor is relying that the index itself will protect that particular investor. And so certainly there's still some research needed. I think picking an entry point, I think dollar cost averaging is always really good. But certainly if I were into ETFs, I'd be managing them a little bit more actively. And so I'd be trying to pick entry points that are good, like when the market crashes. And so for that, I would say there's still going to be some macro level analysis, understanding where's the economy at, where's the stock market at, where's the economy going, those kind of things. But I would certainly say the level of analysis is not going to be as huge as I do with my individual stocks. And so those are the pros. Let's check out some of the cons. Check it out on the screen right now. Cons with ETFs, I would say, is even though they are low, they still have fees. I really don't like paying a middleman if I can avoid it. And so there are some fees, but they are low. With an ETF, I would say this is probably the biggest single takeaway as to why I don't like ETFs is you cannot cherry pick stocks. You're buying a basket. And so let's say, for example, out of the Dividend Aristocrats, one of my favorite companies in the Dividend Aristocrats is Johnson & Johnson. Johnson & Johnson may not be on sale, or it may be on sale, but everything else may be like way overpriced, or vice versa. It may not be on sale, but everything else might be. Because you can't cherry pick individual stocks, you're buying a basket, it's hard to pick value when it exists. But as an individual stock investor, I like looking at my 51 stocks, and at any given time, there's a handful of them on sale. I can cherry pick those particular stocks. That being said, if we go back to the pros list, remember I mentioned very few stock pickers beat the market over long periods of time. So one could argue, well, Ian, is that a con? Because you cherry picking stocks, can you beat the market over long periods of time? Time will tell, but that's one thought to consider. Let's keep going. Check it out on the screen right now. And so next up is, I would say, a con for me, and this one resonates with me. If you watch my last video interview with Sam, I'll link to that in the description below as well. A lot of us dividend investors get some emotional attachment to the stocks we're buying, and I look at that as a good thing because we love these companies, we're committed to them, we like to buy and hold forever. I would say there's less emotional attachment with an ETF because you're just buying an ETF, you're not really buying the stocks individually. So is it as easy to stay committed to that kind of strategy? I think probably for most people it is. I would just say for me, it's kind of the icing on the cake is buying individual stocks. I like having that emotional attachment to the individual companies. I feel proud to own those companies. And I feel proud one day in the future to pass that on to my children and to the future generation, that they would take as much pride in owning some of these companies as I do. Now, I would say also a con of ETFs, and I'm talking about the ETFs I just mentioned, not really the high yielding ones I covered in previous videos, but I would say for investors who need cash flow to pay bills right now, S&P 500 index isn't going to get the job done unless that investor just has a huge amount of money to invest. Investors that have a huge amount of money, multiple millions, sure, it could pay enough cash flow to live right now. But for most of society, for most investors who pay bills with dividends right now, there could be better options out there that yield higher yield and can fulfill the the cash flow needs of that investor without having to tap into and sell the actual equity to pay bills. Now, I want to keep going. Check it out on the screen right now. Just a quick few thoughts. And so many investors choose a hybrid strategy with ETFs as a base. It's a great way to start. Sam pointed this out in my interview last time, where a lot of investors who are just getting started, especially if they're smaller, they might have less money. Commissions are zero here in the United States. Go ahead and buy ETFs as a possible strategy to broadly diversify with lesser amounts of money. And then some investors layer individual stocks on top. Now, also, I want to say, just because I'm not an index or ETF investor yet, at least, it doesn't mean I'm right. It doesn't mean I'm wrong. Each investor is different. And one of the things that I think is so important is we're all dividend investors, whether, at least most of the people here on the channel, whether we try to achieve our dividends through real estate, through individual stocks, through ETFs. It's a similar mentality, and some of us might end up ahead of others in terms of overall returns over the long run. But my main point is investing is important. Investing, education, committing to a long-term strategy. That's what really matters in my humble opinion, and everyone's going to find something that works differently for them. And just because what I found works for me may not work for you, it may work for you. We all have to find our own strategies. And if one of us ends up a little bit ahead of another, that's not really what matters. We're all in a race against ourselves. We're in a challenge, a marathon against ourselves to reach that financial freedom. And that's what really matters. And that's why I've picked the strategy that I share here on my channel for myself, because it works for me. Now, before I get into the interview, one more thing I want to do, check it out on the screen right now. One of the things that Georgiy talks about in the interview is this concept of tax loss harvesting with ETFs. And so I just want to point out up front, there's an article on Investopedia that I found very helpful. I'll link to it in the pinned comment below. And it talks about this concept of tax loss harvesting. Generally speaking, I buy and hold forever. So this is not a strategy that I utilize. But since it's discussed in the interview, I just want to add a word of caution to all of you at home. If you are considering tax loss harvesting, check out this article from Investopedia, and also head on over to your tax professional and ask questions, because generally what the rule says is there's this wash rule. Basically, if you sell something, you sell an asset, you have to wait 30 days to buy it back, I believe, if you're trying to use a loss on that asset for your tax purposes. Now, again, not tax advice, consult your licensed tax advisor. But what a lot of ETF investors do is they'll sell the ETF they're down on because they get some tax write-offs, but then they might buy another ETF to stay in the market. Now, my read of the Investopedia article is those two ETFs need to be materially different. They need to be materially different in the underlying assets, because you can't, because of the wash rule, buy back the same assets even if it's kind of coming through a different ETF. That was my read of the Investopedia article. But again, I have not consulted a tax professional on that, and this isn't a strategy that I do, but I want to share with all of you because there are members of the community who might be interested in this kind of strategy. I thought when Georgiy brought it up in the interview, it was like, wow, this is a very interesting strategy. And so anyway, I want to share that additional disclaimer, that additional point of information. Now, what I want to do next is let all of you know, again, to please check out the pinned comment so that you can go over to Funancialism and subscribe to Georgiy's channel. Check out the pinned comment as well for a link to his Instagram, to my Instagram. I'm active on Instagram now. I do pretty regularly. I've been trying to do them on Mondays. I do an office hours Instagram live, so check that out. And please show your love, your support to Georgiy. He has an awesome approach, and it's very different than mine. He's an ETF investor. He's an individual stock investor, and he happens to invest in collectibles as well. And so he has a different approach. That's why I'm bringing him to the channel. But more than that, the reason I'm bringing him to the channel is he makes financials or finances, personal finance, fun. That's why his name is Funancialism. So he is all about fun, and he's bringing something that historically has been intimidating, something historically that has been off-putting to many people, to the world. And I love that approach. I love what he's doing. He is a very positive person, and because of that, he's adding so much wealth to the community here on YouTube and beyond. And so with all of that, let's move into the next segment of the video. Please, everyone, welcome my friend Funancialism Georgiy to the Channel. Hey everyone, welcome to the interview today. I am so excited to be sitting here on Zoom with my friend Georgiy. He comes from the Funancialism YouTube channel. He brings a lot of fun to the finance space. He also happens to be an expert on ETFs, index fund investing, and so much more. And so we're going to talk about a lot of exciting things today. Welcome, Georgiy, to the channel.
Yo, it is such an honor to be here. I am a huge fan. I'm not even like shy or intimidated to say it, but I've been watching your videos for a while, learning your strategies for dividend investing and carving my own path as well. So thank you so much for having me here.
Oh, you're too kind, and it is my honor. And fun fact for all of you out there, Georgiy is a rapper, and so I am really always on Instagram checking out his rap tunes and his Instagram. So I will link to that in the pinned comment below if you want to check out the resources there and follow him. He has some really great raps about finance and so much more great content on Instagram. So it's equally exciting and awesome to have you here today. And so I wanted to just start out and kind of start from the beginning. How did you get started with investing?
Yeah, so investing is something I discovered while driving to UCLA and back. My commute was about an hour and a half. So LA life, traffic is pretty harsh. And I decided to learn a new skill whenever I was stuck in traffic. So I listened about astrophysics, about fallacies, psychological fallacies, sociology, and investing. It was just a random topic that I thought, I know nothing about this. So instead of wasting time in traffic, I'm going to take advantage of it. And so I ended up learning, no offense to UCLA, a lot more, relatively speaking, about money specifically on the way to UCLA and from UCLA than at UCLA. So that's the main way that I started. I typed in the word stocks and investing, and I found a range of podcasts. And after that is when I discovered, channels like yours on YouTube. And I started listening to that, where it was a little bit faster because you could ×2 the speed, and that's my strategy. So that's how I learned about investing, how I got into it. But I started investing through stock simulators because I was kind of afraid to put my own money in. So for about 3 months, summer of 2015, I just started using a stock simulator. And for anyone watching, Webull has a great paper trading platform where you can start over anytime you want. So that's really cool feature. And ultimately, I started losing money every single day that I was doing the simulator. And I was trading. I was buying a stock, selling it the next day. And finally, I remember it was Disney stock. And every single day I was making like $200, $200. And I was like, oh my gosh, this is a real thing. Holy moly. And finally, I did the math and realized just buying Disney and holding it for that 3-month period would have generated way more money. And that was my switch. Now I knew what to look for when I was researching how to invest, and I could type in the words buying and holding stocks versus trading. And that was the gateway to everything.
That is really interesting because I would say I had a similar experience when I started with investing, that I've made a lot of mistakes, including trading in penny stocks. And so I can totally understand that so many people start out there because that's what all the information is about on the internet out there. And so that's really helpful. And I'd also say, really can commend you for learning all of those things while commuting. I remember my commuting days, just commuting to work, and I listened to rap music. And so you're making very, very productive use of your time. That is really good. And then a tip to everyone at home, 2x speed. I have heard from others as well as a great way to consume content on my channel and also other channels. And so Georgiy, you basically got into then Disney stock and you kind of found the path, like there's something to this buy and hold investing. And so once you were there, what happened next? I imagine at some point you started trading with your own money or buying and holding with your own money. And did you gravitate towards individual stocks, ETFs, index funds? What kind of came next in your journey?
So when I first started, I had no plan. and it was, I just need to do this. And so I read an article about Oprah Winfrey and her involvement in Weight Watchers. So that got me really excited. And of course, I want to say that after all that stock simulator stuff, I was all wise and ready to buy and hold. But the truth is actually, I still wanted to make that quick money and secure it. So I bought Weight Watchers stock as it climbed from $5 to 27. I bought it at about 26. It reached the peak and crashed all the way down to $9. But I did hold it, and I bought on the way down, and I realized, you know what, I need to come up with some strategies, because just buying on the way down without a plan will burn you out. So I learned, yes, from the stock simulator, but from those early mistakes of buying an individual stock just because you read one article about it. Now, ironically, Weight Watchers did end up going to $104 just a year later, but I sold it as soon as I broke even, because starting out investing and watching 66% of your investment lose value, that's really scary when you're brand new to this. But ultimately, I created principles after that experience to just hold on to the stocks that I'm buying. And I wanted to pay homage to my 3-month journey of learning on a simulator. And I bought Disney stock in 2015, and I'm still holding it today. So that's kind of how I started my journey. And then I learned about ETFs and index funds, so I can actually own all my favorite companies inside of one fund and do a lot less research, and it's a lot less nerve-wracking. So I'm holding a lot of index funds, but still I have a lot of positions in individual stocks, knowing that time is on my side, knock on wood. Hopefully I don't get stricken down. And I'm here for a while, but a lot of individual stocks, knowing that I have room for error on my journey. And if my stocks go down, well, okay, I'll just retire at the same time as everyone else. Worst case scenario.
Those are some really good points. I would say Disney stock is a stock I purchased for my kids, and it really has continued to do well. It's interesting that there was some uncertainty during the pandemic with those park closures, but their whole Disney Plus streaming service has really taken off, and it seems as now with parks reopening and reopen, boy, that has been one company that has thrived. And so it's nice to see you've kind of had that throughout your journey from the beginning as something kind of to come back to and really look at as I've had that one since the beginning. I have a question, because you do a mix of stocks and ETFs, index funds. It's a diversified approach. One of the things that people know about me on my channel is I'm all about stocks, individual stocks. And sometimes I get folks in the comments who leave some constructive feedback that, hey, Ian, you're not going to beat the index over the long term. Even if you've done that in the short run, you know, it's going to be very difficult, if not impossible, to do over the long run. Now, I understand that, and I accept that, because I'm not necessarily trying to beat the index. I'm trying to generate index-like returns with more of a cash flow component so I can live off of it. But this is something I see in finance, and I think it comes back to your earlier point too about trading versus long-term investing. There's different types of investing out there, and sometimes they're almost people kind of get at odds with each other about them. They're like, hey, but I'm a trader, you're just a boring dividend investor, or hey, I'm a dividend investor, but I don't do those ETFs, those are not good. And so I'd be curious, you've chosen to include two strategies. How do you come to terms with that, and how do you look at it, and how do you also just explain to people out there that, yeah, individual stocks and ETFs, they're both great?
Right. So I actually have a breakdown of how my money is split up. So about 66% of everything is in my brokerage account, and I have different strategies within my brokerage account. Right now, stocks are near all-time highs. So there's always worry about some sort of market crash. And that's why I love buying ETFs, especially right now, because if there is some sort of giant correction or even a crash, I can sell those ETFs, secure the capital loss, and then buy similar ETFs, basically being able to write off the loss and still keep basically the same kind of stocks inside my portfolio. One strategy is I will sell the most recent SPY or VOO positions, which track the top 500 companies of the S&P 500 index, and just switch that for VTI, which is the total stock market index, which both have a very similar history when it comes to their actual returns. So that's why right now I'm leaning a lot more towards index funds, knowing and kind of feeling that, yeah, with this inflation rate being at 5.4%, which is incredible to think about in the United States of America, but that's a whole different TED Talk. I'm very excited that there is a strategy for investing, especially with ETFs and index funds, in a taxable account when you're nervous.
Yeah.
What else I do is
I'm actually gonna cut you off right there, because this is why these interviews are important. And there's something similar on a different topic, but tax related, that came up at a recent meetup. This is literally blowing my mind. I had not thought of this before, that some of these ETFs are so similar in nature and returns, but they're different. That in a down market, there can possibly be tax advantages to actually moving from one to the other if you're down. And so I would be curious, before we go any further, because there are some folks here who might be newer to all of this, and I do apologize for cutting off your train of thought. Could you just explain the difference between an index fund and ETF, like when they're different, when they're similar, just what these are, and just go one more time, like through these ETFs, what are the tickers, and which are the ones that you like for your own portfolio?
Yeah. Certainly, like this is a really exciting topic, and I think it's fringe, and that's why I love that you create this space on your channel for these types of conversations, because this isn't talked about in school.
No.
It's not talked about on even podcasts. Like this is really fringe information, and it can help relax a lot of people, especially who are older, like my mom who's in her 50s, and me telling her, hey, if you're buying like ETFs and index funds and there's a crash, you're good, you're happy, because you could write it off your income, or you could save that loss for the future when the market's good and you want to sell some stocks. And for people curious about how that works, that's it's just capital gains, capital losses, they do cancel out. And
it can also be carried forward as well. If there's a certain amount of loss that's above the limit, it carries forward. And so one thing worth noting for everyone out there, we're obviously not offering tax advice here, and I'll do the disclaimers at the end of the video. So do make sure to contact a licensed tax advisor for anything tax related, because as Georgiy mentioned, what's being discussed here is very niche and fringe, and it's very interesting concept. I haven't heard of folks looking at it this way before, and so sorry, keep going.
It's actually so fringe that there are a couple of rules that are in the gray. Like this is not a black and white thing. For example, there's the ETF VOO, which tracks the top 500 companies from Vanguard, and then there's, for example, SPY, which also tracks the same exact companies. So my question was, can I sell VOO at a loss and buy SPY, which is the exact same positions inside, but a different company owns them? And the answer is you probably shouldn't, but you can probably get away with it. And this is why talk to your CPA or find a tax advisor, because this is a gray area. Technically, there is a law that you cannot buy the same exact positions. But since it's managed by a different company, it's kind of a gray space, and there hasn't been like a great giant court case about this or anything. But to play it safe, all I do is I sell my SPY or VOO positions, and I buy VTI, which is an index fund that tracks the total stock market. And even though VTI is 3,500 plus different stocks inside of it, and SPY is about 507 or something like that, they're leaned and weighted heavily towards the same positions. So I'm okay. And they're technically different, about 3,000 stocks different. So that's why I choose that position. Now, there's others that you can take. For example, there's VOOG, which tracks S&P 500 companies that are leaned towards growth. And again, they're kind of very similar inside when you look at the top 10 positions. And you can look up top 10 positions really quick on Yahoo Finances. Just type in your ETF and type in positions. Another one is VOOV, which tracks the S&P 500, but focuses on value, right? So one way to memorize that is the G stands for growth, the V stands for value. But ultimately, there might be some branding behind that, mostly because if you look at the top 10 positions, they're very similar, but their ratios are off. So that's why I feel very confident investing mostly in ETFs right now as the market is going up. But we all know that markets go down as well. That's when I'm going to sell some of these positions and just trade them for one another, knowing that a majority of the stocks inside are the same. So the returns should be very similar over time.
Yeah. And it may be almost an interesting thought that with the market being so expensive right now, it may make a little bit more sense to be a value investor. I just see this in my own portfolio. Techs, I don't invest in too many tech stocks. I have a few that pay dividends, but they're quite expensive. They're trading at really high PEs. I mean, Apple, for example, I think it's trading around a PE of say 27, but I have other stocks in my portfolio. General Mills, for example, it's trading at a PE around 15. And so you kind of extrapolate that to the actual index, you're going to get probably a better risk profile at this stage in the market on value. But if the market just collapses, hopefully it won't. And so we're kind of talking about worst case here. But if it does collapse, that might be a time for someone with a strategy like the one you're describing to kind of move from value maybe more to growth. And so if there is that option from a tax standpoint, that could be just an interesting other flavor on this discussion as well.
Yeah, for sure. I think you bring up a really good point about value, because we do know that there are trends in the market. And for the most last 15, 20 years, tech has been booming. But before that, tech was down quite a bit. Stocks like eBay dropped 75% in the early 2000s. Amazon fell from 110 all the way to just $10 in a very short amount of time. So I know a lot of people like, man, I wish I would just buy these in the 90s and hold them till today. You had to tolerate 80% swings and sleep like a baby. That's a lot for a lot of people's stress levels. And most people cannot handle 90% swings like that.
Yeah. Yeah. Now, one thing I wanted to mention is there's a lot of folks in my community and PPC Ian community who love investing for the long term, and they're more about buy and hold forever. And I know a lot of people, they're just averaging into index funds, ETFs on a pretty regular basis. And whereas this fringe concept, it's kind of nice to have in someone's back pocket, just in case. It's not something you plan for, but it's, if there's a complete market meltdown, it's nice to have options out there. But I'd be curious from an indexing and ETF standpoint, what do you think about the strategy of just really simple, really simple investing, of just putting in, dollar cost averaging in regular amounts of money over time, not worrying about the market fluctuations? Is that something that you also do in your strategy?
Yeah. I would say 35 to 40% of my brokerage account is exactly that. Index funds such as VOO, which tracks, again, the top 500 companies. I'm going to keep repeating this because if you're not looking at VOO as a solid part of your portfolio, in my opinion, that's a mistake, not financial advice. But it's definitely something that revolutionized how stocks work back in the 70s with Jack Bogle, who founded Vanguard, changed the game, made it accessible for so many people like us, and probably most people watching this right now. The fees are so tiny. It's something like 2 to 3 pennies for every $100 invested. So I think it is a no-brainer to be buying index funds every single month. But at the same time, I like looking for value. There's something to it that excites me. And not just for stocks. I really like looking for value in other places too. About 16% of my portfolio is collectibles. So
Yeah.
things that have nothing to do with the stock market at all, is independent from the financial system. I think there's a lot of power in holding things that have nothing to do with the system, especially for big corrections. And we saw the power of collectibles. I mean, you name it, video games, Pokemon cards, Yu-Gi-Oh, Funko Pops, all those things went up so much when the market was crashing back in 2020 of March.
Yeah. Yeah, I think that's really interesting. And for those of you watching, we're going to get in. Well, actually, maybe we'll just talk about collectibles right now. We can get started. And so, what is your strategy, Georgie, with these collectibles? How do you look at collectibles as part of your overall stock portfolio strategy? You're saying that's probably, would you say, about 16% total?
Yeah.
Yeah.
About 60% total. My original goal was about 10%,
Okay.
because it is very risky. These things are extremely volatile. They could lose like 50% in a matter of days, or they could double in a matter of days, especially now when the market for collectibles is so hot. Specifically, like sports cards, trading cards is extremely on fire right now. And I started off with the 10%, but my investments have skyrocketed. Now, I think the rule for this is, I kind of piggyback off Warren Buffett, who says, buy what you know, but I level it up to buy what you know and love. So if these collectibles happen to go down, I have some right here. These are on the cheaper end. These are just Yu-Gi-Oh packs. They're about $7 a pack, but sometimes people want to buy them for $20 for nostalgia purposes. Now, these are the reprints. The originals can be like $1,000 a booster pack. It's pretty ridiculous how high they are. One of my favorite strategies is the riches is in the niches. So I go into a hobby like Pokemon because I grew up with it. I played since 1999 until 2002. So I remember those 3 years, and I remember cards like Charizard that back then was $240, and now you would be lucky to buy a first edition Charizard that is in mint condition for $240,000. So they have skyrocketed quite a bit, and my collection's pretty small, but I think that it's okay to have a few items that are very niche, and people do like them.
Well, I think some of what you said is related also, in my opinion, to demographic trends. There's an analyst out there in the mortgage space. His name is Barry Habib. He has some really interesting information. I heard him speak at a conference recently, and what he was saying is basically millennials are finally coming of age where they want to buy homes. They want to buy houses. And that's one of the reasons actually that home prices are surging so much, because there's very limited supply. For all these years in the past, since the great financial crisis, the home builders haven't been building enough homes because they got into so much trouble during the great financial crisis. They built too much and they couldn't sell it. And there is no financing available anymore because of those loans were so levered up. But now, because we have years and years of limited supply, and the millennials, it's like a wave. It's this just block of people finally trying to buy homes. There's not enough, pushes the prices up. And because the millennials are buying a little bit later in life, they've got more money. It's where they're not buying anymore on zero equity down loans. A lot of them are coming in with huge amounts of cash. But what that tells me also just about something like Yu-Gi-Oh cards is those same people have money. They've been saving it up. A lot of them have been frugal. Not all of them, but a good chunk of them have been frugal, and they have some money and they want to remember their childhood. They want to buy these things that's one of the reasons I enjoy wearing Air Jordan shoes, for example. It reminds me of my childhood. I'll tell you, one of the stocks I own, Hasbro, the reason I own it is because they own Magic the Gathering, and I played Magic the Gathering during my earlier years, and I have thought about investing in some of those rare cards or rare packs of cards? I mean, I think for me, I'd want like a booster pack from like the beta series or something like graded, like something nice, you know, but I haven't taken that step yet. But I can understand the mentality behind why these things are going to get more popular. And I'd be curious, just in your wanderings, Georgiy, have you seen anything like that where it's kind of a picking up of interest because of those types of trends? Just people who are really kind of yearning to remember those times that were a lot simpler than they are now and owning a piece of that history.
Yeah, I do believe like collecting has always existed. Like with baseball cards, it's a 100 years of history. So
Mm-hmm.
people always say like, well, this Pokemon thing's only since the 90s. So like how much can you really compare that to, say, an index fund, which again only existed since the 70s, but investing as a concept in stocks existed for more than a century. But I do think that baseball cards have been around just as long. And I think Pokemon cards, Yu-Gi-Oh cards, like the nostalgia behind them. Imagine being able to unlock these
Mm-hmm.
memories by just touching an object. I think that's precious. You get to conquer your childhood in a way where the first edition Charizard that like your best friend's big brother had stored in his closet, you
Mm-hmm.
finally get to have that. And people are willing to because I think in a way we're kind of spiritual creatures, like we're searching for fulfillment on this planet, and one of those ways is through ownership. And I think owning a house gives people like
Mm-hmm.
pride. I have something to take care of. And the same way when it comes to trading cards, it's like, wow, this was the greatest baseball player of all time, this was the strongest Pokemon, and I have it, I get to take care of it. And because it might be extra rare, you know that only 30 other people on planet Earth have this card. So you are one of
Yeah.
the few. That's a goosebumps feeling. Like I'm talking about that. My legs hairs are standing up. Like, there's power to that.
Absolutely. And I think there's an important point here that parallels other forms of investing. One of the things I've just learned over my years is, look, I invest in dividend stocks and I'm kind of stuck in my ways. So for me to take big positions in trading cards, maybe I will, maybe I won't, but you never know. But what I would say is, for those out there in the community, I'm sure there's some that are all into collectibles, others that might be more like me that I don't know if I'm going to do it or not. But the fact of the matter is there's lessons to learn from all of these different forms of investments, whether you're in it or not. And one of the things I would just say from observing collectibles, but also observing life, is we're in, and I see this in stocks, we're in a kind of winner takes all society, in my humble opinion, where you want the best quality you can afford. And so I'd be curious on your comments in this in a minute, Georgiy, but I've seen this with a stock like Apple. When Apple crossed $1 trillion market cap, I thought that was a really big deal. And I would have, I thought that was like, wow, that's got to be it. It can't go much more than that. And now it's at like 2.5 trillion just a few years later. And I would have never fathomed that it's possible. But the biggest and best keeps getting bigger and bigger and bigger. It keeps becoming the best over and over and over. And I see this with real estate as well. You can always get cheap real estate that no one drives towards. And maybe it's really hard to get utilities to them because all the utilities aren't in the street in front of it. And so if you want to develop the real estate, you have to bring in the utilities, but that's going to cost you a few $1,000,000 and it doesn't pencil out. It'll never work. That dirt will always be cheap. But if you want to get a piece of land, it's near a freeway, it's got the utilities there, it's possible to develop it and get a lot of traffic going by for your business, that's going to be a lot more expensive. It's a flight towards quality. And I'd be curious when it comes to this concept of investing in collectibles, from your experience, Georgiy, do you look at it that way or no? I'd just be curious, is there like this concept of the investor is generally better served going towards quality?
So there's a way to operationally define value when it comes to collectibles, especially with cards. So it's popularity. How popular is the character? Then it's scarcity and how difficult it was to originally obtain this card. And then it's population. So how many actually exist and exist in a specific grade or condition? And you can actually look up how many of each card has been documented by professional grading services. Now, there is room for error in that, especially if you're looking at really niche cards. They even make mistakes because no one knew. I'm holding a card right here, and 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 these all look exactly the same. Exactly the same. They look so similar that the professional grading company actually got them confused for one another. Specifically, this card right here. This one is very different from the rest. So everyone in the year 2000 got to see the Pokemon 2000 movie about Lugia. And if you went the first week, every kid in elementary school had one of these, an Ancient Mew card. But they were released in Japan earlier, and the very first printing of that card accidentally said the word Nintendo instead of Nintendo at the bottom. And then they corrected it, and then they mass released it in the theaters. So that corrected version had a very small print run where it wasn't even recognized by professional grading companies. Now, you could go on eBay right now and find one of these cards that's graded a 9 out of 10 for about $300. And usually most people pass it up. But me, I see value in that. I see something that is extremely scarce and no one knows it. I see the population report completely inaccurate, and I see the popularity. It's Ancient Mew from the year 2000. This is the most unique looking Pokemon card. The back is so different compared to like a regular card. So I think that's where I go. I go to that scarcity, the population is low, and it's a very popular card in general. So that's how I look at value. And I talked to this guy, Jeremy Padower. Google him. He worked for Hot Wheels, for Pokemon, and he's huge on collectibles and one of the first people to publicly purchase cards for over hundreds of thousands of dollars in the year 2019, where it actually hit mainstream media and you could see articles about it. Guy buys the first set of Pokemon for 180K plus. So here's something that he told me. When you're investing in collectibles, because I'd always bring up Beanie Babies. Like there was a huge boom and it lost it. And I was asking, could that happen with Pokemon? And of course, no one really knows. But think of collectibles like a pyramid is what he told me. The collectibles at the very top of the pyramid, the Beanie Babies that were trading for 20K plus back in the late 90s, early 2000s, they retained their value, if not increased. But the accessible Beanie Babies, they dropped in value to almost nothing. And we're seeing that in Pokemon right now, where a lot of modern products, you pick them up at the stores like Target, they're all sold out, shelves are clean, maybe $60, $80 to buy all those packs, and you could resell them for triple. Well, now they lost almost 50% of their value going back to what they were selling in stores. But these really rare cards, they're not losing much of their value. Right now, sports cards, Yu-Gi-Oh, you name it, 50% correction, except for the cards at the tip top of the pyramid. They are increasing in price, if not just retaining their value.
Absolutely. That makes a lot of sense. And so there's kind of this concept of flight to quality, similar to the class A real estate, if you will, but there's also the concept of value investing. Like I see a stock market where overall the PE ratios are like in the 30s and 40s, but I can buy General Mills at a 15, which is at a really good value. And I think that it's mispriced. So there's this concept of something being mispriced in the market as well. Now, my channel is mainly about passive income and cash flow. And so when I buy an asset, I never plan to sell the asset. It pains me actually to sell a stock. It's terrible. And so or sell real estate. And so my question for you is, what is your eventual financial goal? So you've got the 16% of your portfolio in collectibles, and that probably has very different, I guess asymmetrical returns is what I think it's called, or it does not correlate with the rest of your portfolio. And so it kind of helps you weather the volatility, if you will. And so you've got that portion of the portfolio, and then you've got the bulk of the portfolio, say 84% or so, in index funds, individual stocks. I imagine other forms of investments, maybe cash equivalents. I'd be curious, like, as you build your portfolio and as you get older, do you have a financial goal ahead that you're striving for? Like, by this certain age, I want to do this, or I want to work fewer hours. I want to maybe use my portfolio to accomplish this goal. What do you see in your future? And how are your finances, your financial strategy going to help you achieve that?
Yeah, so when I first started investing, I was going in blind. I knew this was a healthy thing to do, kind of like when you're going to the gym, you don't really have a plan, but
Yeah.
if you're going for a few months, you're going to get stronger, you're going to lose unhealthy fat, and you're going to gain muscle. So same for me, I went in blind and I just started after the stock simulator. And I'm so glad that I did. Now, if I know what I know now, I would probably have double, if not triple the net worth. But that's hindsight. I sold a lot of amazing stocks and companies. Like, one example was Restoration Hardware. Bought it for $25, sold it for $35. Thought I was a genius. Today it's between $600 and $700.
Wow.
I bought back in though at 183, and I bit my wrists, and I was like, okay, you know what? This is a good call in my opinion. I'm going in. Berkshire Hathaway purchased shares as well. So I had a similar experience with Apple as well, where I bought it really, really early, the day before the Buffett team actually bought it in 2016. I was there before that happened. And as soon as I saw 20% returns, I was like, this is amazing. An investor's supposed to get 7 to 10 a year. I doubled that, tripled that. I'm selling. Big mistake, big regret. But I learned, and I bought back in on Apple, and I just held it. And Apple actually skews my portfolio so much because I don't rebalance much. I will rebalance later in life, and I'll tell you about my ultimate goal in just a second. But Apple, because of the growth, is now 13% of my brokerage account, which is awesome.
I love that.
But I'm just holding it, and it is tough, and it is a little bit scary. But you know what? Like, if it goes back to what it was, okay, I'm back to where I was. If it crashes to zero, it's 13% of my brokerage account. There's a bunch of other funds and stocks in there, diversification. I have my Roth IRA, which is all individual stocks, by the way. So yeah, I went in because I can't touch that money for 30 years. So I figured, why index inside of there when I could take much more higher risks with individual stocks? And earlier you were mentioned, I know I'm kind of sidetracking the conversation.
This is great.
But earlier you mentioned, like, a lot of people in the comments usually mention, hey, like, the data is in, index does tend to outperform most investors. So I agree with that. I can't disagree with the data, but I still choose this higher risk approach because I have time on my side, because I can rebalance, especially in a Roth IRA where you don't have to think about taxes, right? Like, it is what it is. About, I would say when I first started, 33% of my Roth IRA was in Nike stock. It just was. And now it's maybe 35, 36% in Nike stock as I contributed more throughout the years. Actually maxed it out only twice. So that's $12,000 invested. It's currently at about 18.8K with huge fluctuations. But that's the power of buying individual stocks earlier on in life, in my opinion. So with that, my ultimate grand goal here is to be able to live off of my investments by selling a very small percentage of them by the year 2029 to 2034. My goal is to reach $1.25 million and be able to take out 40 to 50,000 and live a frugal, humble life. Kind of like a quiet millionaire. My wife, she's not my wife yet. I don't know if you watching this, but one day, she wants to be a teacher, so like she can do that, and I will be able to, my goal is kind of stay at home, be a dad, and work on financial literacy, spreading the knowledge here, maybe craft a little bit. But that's why I'm working so hard and investing a majority of my income, living at home with my mom still, who saw the power of investing. And she's like, you have way more money than I did at your age by like,
Yeah.
I don't know, 99% more. So like more than 99% more. Like this is amazing. So keep doing this. So everything that would be rent, which is an average of $1,500 in the United States, I am investing full force.
Yeah. So there's some really good things here I want to unpack. First thing I jotted down was Apple stock, and I have a similar Apple story. I don't even need to get into it, but basically I was late to the game. I could have been a lot earlier. But that being said, being late to the game, it's still one of my best performers. It's done so well. And I continue to buy more to this very day. And so one of the lessons I would say is so many investors, they feel like they missed the pitch and they feel like, oh, I'm doomed because I had this opportunity and I missed it. But the fact of the matter is, there are good opportunities out there in the stock market, the financial markets every single day. It's impossible to miss the pitch, or I guess you could miss it, but it doesn't hurt the investor the way it would hurt someone actually in a real baseball game, because there are so many more pitches coming. You can't strike out, just keep waiting and waiting. Kind of the Warren Buffett strategy. He'll wait around forever. And so I think that's a key takeaway. And I've found in my investing experience as well that I've done well despite missing some pitches, and I've missed a lot of them. And so something else that I jotted down that I thought was really interesting was Roth IRA. And so it sounds like, Georgiy, you have a great approach of individual accounts and retirement accounts, and it's a blended strategy. And I think that's one thing I've taken out of this interview so far is it's not necessarily, sometimes on my channel, I feel like I'm pretty laser focused. I do everything that I pretty much discuss, and the core of what I do, it's individual accounts, since I'm trying to live off of cash flow at an earlier age than the typical retirement age. But it's important for people to remember that it's okay to have a matrix solution in one's financial strategy. It doesn't have to just be one thing. It can be ETFs and individual stocks. It can be ETFs and Pokemon cards. There are different layers to the financial game. And the third thing I took away from what you just said that I think is really important is this concept of withdrawing money and living off of money that one has accumulated throughout their life. So what I typically discuss on my channel is I plan to live off of dividends. I don't plan to sell the principal. And the problem with that is it's more difficult because you're going to wait longer. You have to have a bigger portfolio to be able to live off of just the dividends. And it's a strategy that's worked for members of the community as well. I interviewed a friend, Sam, at the meetup recently. However, that's not how everyone looks at it. And so whether you're a growth investor or dividend investor, it's also possible to look at it that, yeah, I'm going to live off of my dividends, but I'm also going to have to sell some of the principal. And it's worth that to me because I can achieve the financial freedom quicker. I don't have to delay it and accumulate so much. And I'd be curious, like, Georgiy, if you could go into that a little more, because it's something I never discuss here, but I know a lot of finance people do. And a lot of finance people, they look at this kind of I think it's like a 4% rule or something, like safe amount of withdrawal. And I'd be curious, like, do you plan to live off of the dividends? Do you plan to, do you look at the dividends? Like, is that something of value to you? Or are you purely looking more at like a portfolio value and kind of the safe amount that you're able to withdraw from the portfolio?
Yeah, well, I'm a constant viewer of your channel, so I understand the power of dividends. I understand that for the last 40 years, about 75% of the S&P 500 returns is because of dividends reinvested. So I definitely do not underestimate the power of dividends. And a lot of OG investors may even like critique and ridicule like something like collectibles, which there's no cash flow there. But I want to argue, if you look at the Mona Lisa, we all know there's value, but there's no cash flow. So I use different philosophies for different dollars. So it's kind of like a society needs people that's conservative, that's progressive, that's libertarian, et cetera, for this balance. So I look at money the same way. It's a society. It has different goals and basically desires. So I kind of personify my money a bit. So I am planning to rebalance a lot closer to an almost full index approach by the time it's 2029 to 2034, slowly sell off some of those individual positions. But I'm not going to be doing that until something like 2027. So I have years rather than prices dictating my behavior. And one thing I probably should have mentioned in this interview is I'm a behavior analyst for my day job. So I create behavioral contingencies for myself because at the end of the day, a lot of people are still having their money rule their life, even if they're investors. They're looking at prices constantly.
Yeah.
And that's how I started. But I want different things basically influencing my behavior. So I'm a time-based seller, but at the same time, if something amazing happens in my portfolio, like a stock skyrockets 100% in a month, and it's too good to be true, I have a rule. I will sell 40 to 50% of that position and reinvest it into more conservative funds. Ultimately, my plan is I will be taking out 3 to 4%. And I do not care if it's dividends. I do not care if I'm selling the stock. I care about getting my needs met, being able to pay for the mortgage or for rent. I'll probably be renting. And kind of move from there. So my goal is how can I see $40,000 to $50,000 annually for my investments? I do not care how it's done. And one thing that some people might be thinking is, well, how are you going to collect dividends off of a card, right? So I would probably have to trade my collection or be a little creative by maybe talking about the difference between all of these cards on a YouTube channel and getting passive income off of YouTube. How is that not a dividend? So I can make these collectibles, these artworks actually turn into streaming money. So that's kind of like a dividend.
That's a really, really interesting point. And I think my main takeaway from this, I think it's important for people on my channel to hear this, is all these years you've heard one person's perspective. Now I'm starting to bring in other perspectives to the channel. And I think it's important to realize that there are different ways to accomplish the same goal. And sometimes you also have to be aware of what kind of faults may exist with my strategy. And one challenge that I face, honestly, is it's interesting you bring up this behavior stuff, because I get basically married to my stocks and I look at them almost as like collectibles in some ways. This is probably why I gravitate towards individual stocks so much, because when I own it, it's like a sense of pride that I have. And then it's like my baby and I can't sell it ever. And then you kind of become almost like, is it creating freedom or is it creating like this attachment that you can't free yourself from? And because I can't sell it, I'll only be comfortable retiring when the dividends can pay for my lifestyle. But because of all these rules I've created, because of the attachment I have to these stocks, am I delaying my retirement by 10 or 20 years even? And so there's these things it's important to hear these different perspectives, because then you can come back and question your own strategy. Now, am I going to change my strategy? Who knows? But it's always good to think critically about yourself, because it seems like Georgiy is employing a strategy that will allow him to retire sooner than I would with the type of strategy I have, because I'm not planning at this time to sell stocks. And so I think it's really important to hear this. And I think it's really important as well. And I like maybe as we wrap up the interview today, in terms of a kind of few just closing thoughts, I'd be curious, could you elaborate some more just on how you set up rules for yourself, whether it's in finances or also in your life, like maybe some like happiness tips? Like I think in our world today, we're coming out of the pandemic. You're hearing all these things about people are really fatigued. I've felt it. Going on vacation recently was a real eye opener for me. I realized like, oh my goodness, like this last year, it's been pretty crazy. And so I'd be just curious, like for finances and also life, if you could speak, if you're allowed to speak, like from your career and your professional standpoint, like how do you see some of that knowledge you've accumulated in your career? How could that improve the lives of those watching this video?
Jack Bogle, like what a legend. And him, Warren Buffett, they all say kind of the same thing. Investing is 90% your behavior and 10% the behavior of your stocks. So
Mhm.
most people end up getting subpar returns, not because they picked the wrong stocks or indexes or whatever it is, whatever strategy they picked, but because they let go at the wrong time, or maybe bought a little too aggressively on the way down and it wasn't going to recover and things like that. But ultimately, 90% of our returns is when do we click a few buttons on a keyboard? That's what it comes down to. I operationally define investing as pushing buttons on a keyboard. If you can buy things on Amazon, you could buy Amazon. So that's kind of how I see it. This is, earlier I said, a spiritual journey as well. You really get to know yourself while you're an investor. That's why, like, I look at investors with a different type of respect than I do at, everyday consumers. And if that's the path you choose, that's the path you choose, like no judgment. But I just naturally feel like this, wow, you're an investor. You are thinking both in the past, in the present, and the future. You're a time traveler. You're buying when stocks go up, when stocks go down. I mean, 2020, we could buy index funds for 2015 prices.
Mhm.
We could buy Disney for 2013 prices. I definitely wanted to buy Disney in 2013 if I could. So when I saw those prices, I went in. But as a behavior analyst, you have to set rules. Otherwise, you're going to be dictated by money, even though you're an investor. And the whole point is control your money. Don't let it control you. You influence your decisions, not the money, not the prices. So if I buy a collectible and it skyrockets, well, I'm holding on because I made a rule. And most people who saw their Charizard cards double in a year from 30K to 60K, well, they missed out on 350K. We had a $500,000 sale a few months ago. So that's why setting these rules will pay off way more than just kind of chasing the money. Again, it's okay to make money-based rules too. If this doubles in X amount of time, I will sell X amount of this position. So before you buy a stock, know when you're going to sell it or know what you're going to do with it. If you're buying a stock, you have to write certain rules down, and this can be up to you to decide. I have my own personal rules, and I've shared a couple throughout this interview, and you have to make your own as well, because behavior therapy, behavior analysis, it's an individualized process. You're not going to go to the gym the same way someone else does. I'm not going to invest like Ian, even though part of my portfolio is investing like Ian. So creating these rules that are inclusive of your spirit, of your soul, of your journey is the key. Creating behavioral contingencies that you follow no matter what, and creating rules for you to even break your rules. Like, I'm a buy and hold investor, but if I buy a stock and it goes up 100% within like a couple of days, I sold all my AMC stocks.
Yeah. Yeah, well, this is a great. I think this is a great note to end today's interview. I wish we could actually go on forever, so maybe we'll do a part 2 in the future. I would say this is one key point, and I think this is so important because I get the comments all the time in the comment section. But Ian, you're not going to beat the index funds, this and that. I think that is a valid point. Maybe I will, maybe I won't, but I'm doing something that works for me, that keeps me committed to the market. But I think the key out there is whether you invest like me, whether you invest like Georgiy, whether you invest like another amazing YouTuber, Brandon Beavis, whether you invest like a Gen X dividend investor, another great investor, we all do it maybe a little bit differently. But the fact of the matter is we all have a system that works, and we're doing it, and we're trying to stay committed to it for the long run. And I think that's part of the point here, is it's just finding something that works for you and being able to stick to those rules. And maybe my performance won't be quite as good as Georgie's, or vice versa. And when we're at the end of the day, whose portfolio is up the most. But that's not the point. The point is getting involved in the market and participating in that upside to provide for a better future. And so I think that's a key point. And I love this concept of just writing down rules. It's been far too long since I've updated my investing journal. At one point, I had been updating my journal pretty frequently, just with thoughts and ideas like where I am in my journey and what I want to achieve and what I foresee for myself in the future. And it may be that that's a good place. If you keep any kind of journal, just try to write down your rules, try to write down, where are your limits with investing and what are you trying to achieve? And it's probably okay if that evolves over time. Maybe after seeing this video, you're not just going to do dividend stocks, you're thinking about collectibles. And so and by the way, if you want to learn more about anything discussed today, please head on over to Funancialism. This is Georgiy's YouTube channel. I'm going to link to all these resources below in the pinned comment. And I'll also link to his Instagram, which is amazing. And if you love hip hop music, rap music, or just kind of humor, one of the reasons I actually wanted him on the show as one of the first guests that's ever been on PPC Ian is because of what he's doing for finance. This is the man that's making finance fun. He's making it humorous. He's making it accessible to more people. And ultimately, as YouTubers, it's nice to be on YouTube, but anyone will tell you it ain't easy. It's a lot of work. But the reward is getting that motivation out there. And this is someone firsthand who took the time to be on the show today, who you'll see if you get to know him even more through his Instagram, through his YouTube. Just a really cool guy, wealth of knowledge, and making it fun for people. And so I just want to thank you, Georgiy, for being on the channel today. I hope everyone really enjoyed the video, and I can't wait to see in the comments section below any other comments or thoughts you have. Share them, and certainly smash the like button to show your support for Georgiy and his work here on YouTube and Instagram. So thank you, my friend, for being on the channel today.
Wow, that was amazing. Thank you so much. This feels like the moment where Kanye West picked out Big Sean and was like, you're a rapper. So like I got a little teary in my eyes. I'm like very proud of this moment. It's a big deal for me. So thanks so much for having me on.
It is an honor, my friend. So here's what we're going to do. I'm going to end the interview now, but stick around because I'll have a little outro and I'll do my disclosures and disclaimers there. But I just do want to reiterate, even on this segment, that everything discussed so far, it's not financial advice. It's just for fun and entertainment. We're just sharing our personal journeys. It's not tax advice. So definitely you want to consult your licensed tax advisor, financial advisor, and stocks and assets mentioned today. Either I own or Georgiy owns or both of us. And so I'll do the disclaimers at the end. But again, just want to make that, make that aware, everyone aware of that. And anyway, I'll see you all in the next segment. Thank you again, Georgiy. And so hang in there, everyone. I'll see you in a minute. All right, everyone. I really hope you enjoyed that interview as much as I did. It was a pleasure. We honestly, fun fact, Georgiy and I have been talking about doing that interview just forever. And we finally made it happen. And by the way, Georgiy also interviewed yours truly, and he's going to post that video. He may even break it into a few different videos over on his channel. So again, subscribe to his channel. I linked to it in the pinned comment below to watch yours truly over on Funancialism. Now, before we end the video today, I just want to get into a quick housekeeping item. The last video did really well, and a lot of it is all these friends over from Brandon Beavis Investing. I love you, my friend. Again, check out Brandon Beavis. I linked to him in the pinned comment. Watch the video. Anyway, I got a lot of questions about Sam. Where does Sam get his clothing? And also this book he was mentioning, The Dividend Drill. I can't find it. Where is it? So check it out on the screen right now. I just wanted to let you know that Sam gets his clothing at a store called Everlane. I believe they sell online, and they also have a store in San Francisco. So check out Everlane if you want to look as awesome as Sam did in the interview with me. He is someone living off of dividend income, a true OG thug life dividend stock investor. And the book he mentioned called The Dividend Drill, a lot of you are trying to find it. And there's a reason you can't find it. It's been renamed. It's now called The Ultimate Dividend Playbook. It's by Josh Peters. So head on over to your bookstore or to Amazon, check out that book. Sam loved that book, and that was one of the ones that got him interested in dividend stock investing. All right, everyone, before we leave today, don't forget I have a Patreon, and so if you want even more bonus videos, I have 40 bonus videos there now on Patreon. You unlock all 40 instantly if you sign up. It's only $3 a month. You can cancel at any time, and there's other bonus content over there as well. So check out my Patreon. I'll link to it in the pinned comment below. Boy, his pinned comment is getting really long today. And before I leave, in terms of a full disclosure, I own the stocks mentioned today. I am long Johnson & Johnson, ticker J&J. I'm long whatever stocks were mentioned that we talked about in the interview with Funancialism. I'll just kind of put them on the screen if I own them. I think one of the ones Georgiy mentioned was Disney, and my kids are long Disney. And also Apple. In terms of full disclosure, I'm long Apple, AAPL. What a stock. And in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the stock market. Same goes for Georgiy. He's here just sharing his journey, not providing any financial advice. And also, this video does not offer any tax advice, anything like that. Please consult your licensed tax advisor before taking any steps as it pertains to your finances or your taxes. I love you all. I'm going to see you all in the comments below. Please don't forget to subscribe. This was a really long video to produce and to edit, and so your support through the subscriptions really means a lot. I love you all. I'll see you in the next video.